We had a large civil contractor on a job. He walked away. I had another one this year where the electrical contractor, they walked away midway through the project, and there was no bonds, and there were no SDI, right? So both of those were 7-figure hits. It's your responsibility, whether you're the owner, developer, or lender, to decide what your risk tolerance is. It's my job to tell you what the risk is and provide some risk transfer mechanisms. We make sure that proper insurance is in place and risk management tools are in place so that either your asset, your investment, or if you're a lender, that you're properly covered. So we're just going to give a quick example today on a new construction deal, right? So this could be a mid-rise, it could be a high-rise, it could be garden style. It's all going to be the same as far as what we're looking at. So we've got a basic apartment community. We'll call this one a garden style. We got multiple units, multiple buildings. Let's talk about some of the parties that could be at play. So in a typical apartment deal, or a multifamily ground-up construction deal, we've got our owner-developer, or we've got our lenders. Now, these are the parties that we could provide services to, right? And under owner, developer, and lenders, we've got a subset of investors, right? These investors could be high net worth, it could be family office. That's typically what we see in a lot of the apartment deals. And or it could be an alternative lender. We're not going to get too much into the mezz structures now, but you could have different lenders. You could have a mezz piece. But essentially, the investor services that we provide are very similar to a lender. And often the investors are overlooked. So that's something I want to talk about and harp on a little bit there too. So on a typical ground-up construction deal, what type of insurance coverage do we have? We have our property coverage. For construction, it's called builder's risk. We have our liability coverage. What do I mean by liability? Liability for the construction project to make sure that all the subcontractors have their proper insurance, depending on the insurance structure, or that the project itself, which is what we prefer to do, has the proper insurance should anything happen after the course of construction through the time of repose, statute of limitations, essentially, that you have proper coverage. And then third, and very importantly, this is often overlooked, is financial. What do I mean by financial? This is bonding. It's either going to be bonding or SDI, which is subcontractor default insurance. So financial, we're going to have bonds, payment and performance bonds, or two, SDI, subcontractor default insurance, right? And I'll talk a little bit about all of these. So on property builder's risk, the services that we provide or what we can do is going to be essentially the same for all. It depends on who our client is, right? For the owner developer, we want to make sure that their equity is protected. For the investors, we want to make sure their investment is protected. And then for the lender, this is going to be the lender collateral, right? We want to make sure that proper endorsements are in place to make sure that collateral is adequately protected. So property builder's risk, it's just that. During the course of construction, if we have a fire, if we have a wind event, if we have any type of event that causes a loss to that structure while it's under the course of construction, that's going to be property. It's also called builder's risk. What we do on these is we actually have to set limits. There's no typical hard or soft cost. There's somewhat of an industry standard, but what we do is we review the contracts. We work with whether it's your construction manager, your GC, and a lot of times the architects and engineers also to review the detailed construction contracts to make sure that the proper coverages are in the proper buckets. What do I mean? We've got hard costs, we have soft costs. Sometimes we even have some business income in there if it looks like there's going to be a BI exposure towards the end of the project, right? So we always want to make sure it's not as simple as just you've got a $100 million project, you go buy $100 million of insurance, right? We break those limits down into the specific buckets where they need to be allocated. So that's property under the builder's risk. Next is liability. One of the things that we always recommend, and typically based on the size of projects we're involved in, is we can introduce something called an OSIP, or an owner-controlled insurance program. That's going to provide direct protection to our owner-developer, and it's actually very good for the lenders too, because you have one insurance program that's a master insurance program for this one project. So there's less identification and research into the GC's insurance and every single sub's insurance and every single subcontract agreement, right? So that protects a blanket coverage, and we'll talk more about that technically some other time, but on most of our projects, we're looking at doing an OSIP, or depending on who the GC is, if it's a large GC, they'll have a rolling CSIP, a contractor-controlled master insurance program. So the important part on that is we always want to make sure that the contracts mirror the coverage. because you could have coverage that needs a contract trigger, right? The coverage is going to require certain things in the contract. So that's why we review all of the construction contracts, typically with the owner developer and the construction manager or the GC. And then depending on the projects, on the smaller projects, we might even go down as far as reviewing all the subcontractor agreements. Most of ours are larger that doesn't require that, but we do have that ability. And something else we do on that note is if we are dependent on the subcontractors, we'll implement something called a vendor insurance tracking. To where we'll implement a system to track that subcontractor's insurance, and prior to any draw requests or any payment made, along with the lien releases, we make sure that they're providing proof of coverage, and essentially based on their retainage, and even looking forward 12 to 24 months at the project end, we still want to make sure they have proper coverage. So those are some of the services that we provide and offer too. Something else that's really overlooked, I want to talk about the financial. So what does liability cover? If there's something that happens in this project, let's say we have a plumbing contractor that has a bad fitting, it causes a flood to the building, right? That is a liability exposure. It's not a cause of loss under the property or the builder's risk. It's going to be because of workmanship that one of the subcontractors caused, right? So we have, let's say this building is completed, a month or two after construction, and we have a plumbing fixture fail, right? It could be workmanship, it could be the product, but that's going to be a liability issue. It's actually not going to be a property issue. And most of your completed property policies are actually going to exclude any type of construction defect, right? So that's where the liability would come in. And that's why the properties, all of these are important, but liability, especially if you're a lender picking up something off of a recently completed project, you really need to review the liability program that was in place prior to and during construction, right? Because you could easily be on the hook 5 or 10 years, depending on the statutory repose in the state, of this liability program that's actually going to respond potentially instead of the property. So that's something I always want to talk about with lenders. Anytime we do a lender review on a new construction deal or recently construction deal, we always look at the liability program because that could still provide some coverage. All right, financial, bonds and SDIs. So payment and performance bonds. What does that mean? Let's say you've got an electrical contractor. They're 50% through with your project. It's a $150 million project. Their scope's going to be a couple $1 million, right? They go insolvent. They walk away. What do, right? So you've already paid that electrical contractor. Of course, there's going to be some mechanisms in place there, but chances are you've already fronted some money to that electrical contractor, and now he can't perform, he can't complete the job. So on a typical payment and performance bond, they will provide a bond when they bid the project, right? And then they'll also provide a bond saying that they're going to complete the project per their terms of their scope and their proposal. Now, through the 2000s, construction payment performance bonds, because of the crash of the market, became very, very difficult, right? Become very difficult for contractors, even large contractors, to get bonds. They were having to sign personally, and they still do. If you're a bonded contractor, you know this. It can be tough. They ask for a lot of collateral from the contractors. So there's there's another product that's actually gained popularity of recent years. It's called SDI, or subcontractor default insurance. And the beauty in SDI is that we can have a rolling program from the general contractor. It's not bonding, but it's very similar to bonding. It provides an alternative, right? Again, these are financial products. They're not insurance, but it'll provide a recovery mechanism if some of your contractors go insolvent. One of the things that we do, of course, we review the payment performance bonds, but on the SDI, the subcontractor default insurance, there are just like this actually is an insurance product. It's a financial insurance product, but there's certain specs in the insurance where they might only provide up to $500,000 or $1 million, depending on that subcontractor scope. So what we do is we ask for a copy of the insurance. We want to see what limits they provide, and we also mirror that because we're already going to have the budget. We mirror that with the entire project scope to make sure that sometimes we might end up carving someone out of the SDI and require them to do their own bonding. Sometimes we might ask them to increase the SDI amount for the specific project. So that's why just because someone has SDI, we need to look at it. We need to review it. We need to make sure that you as the owner developer or as the lender, or if you're the investor trying to get coverage or protect your investment, that there's proper endorsements in place to provide protection. Now, again, just to recap, why are the financial products so important? I've had this happen even within the last year. We had a large civil contractor on a job. He walked away, right? He was not bonded on that job. We came in. We were part of helping fix what we could. I had another one this year where the electrical contractor, they walked away midway through the project. and there was no bonds, and there were no SDI, right? So both of those were 7-figure hits. And the SDI on something like this would have been, for the entire project, I think it was, we looked at it, would have been $150,000, right? So that's why it's so important. One, to either make sure you have it and review it, but again, it's your responsibility, whether you're the owner, developer, or lender, to decide what your risk tolerance is. It's my job to tell you what the risk is and provide some risk transfer mechanisms. So again, our goal is to identify what the exposure is, whether you're the owner, developer, lender, or investor, and make sure you have proper coverage. So on a ground-up construction deal, we want to make sure that you have the property coverage is going to be the builder's risk to cover, whether it's a fire or wind event or any type of event that's going to damage the property. Make sure you have the proper liability program in place. This can be all of these are intricate, especially with ground-up large construction deals. We want to make sure that you have proper coverage through the statute of repose so that if you have a lawsuit, and this happens all the time, several years post-construction, that you're protected as the owner, developer, the investor, or lender. And again, if you're a lender picking up a deal that's been recently completed construction, it's of utmost importance. Most lenders are not looking at the liability programs of something that's been recently completed. And then third, and very important too, this is often overlooked, is the financial side, right? We want to make sure there's either bonds or SDI in place, because I'm not sure what the market trend is, but even this year I've had several projects I was not part of setting up initially, but we're seeing more losses on the financial side with contractors just walking away because they can't, they've had some financial difficulties. So this is just a brief recap on a new construction deal. Any questions, feel free to reach out to us as part of Risk Management. Be happy to help you out. This is what we do, and we want to look forward to helping you on the next project.